The JSE Financial 15 index has returned 20% year to date, with Absa being the outlier in this group, with a negative return thus far. More recently, the unsecured lenders African Bank and Capitec have been under pressure. For more on the sector, Patrice Rassou, Head of Equities at Sanlam Investment Management, he joins us on the line from Cape Town. Hello, Patrice.
Hello, Erica.
Why the strong performance? Let me just start there. Does it start reminding you of what the retail sector has experienced over the last 2+ years?
It's quite interesting. Really, the financial sector post the financial crisis were really a neglected part of the market. I think the financials were painted with the same brush as their developed market counterparts, and no one wanted to touch them. And there was a feeling that there was a lot of risk as bad debts were spiking and results were pretty poor. But what we've seen since last year is they've turned the corner. Bad debts have been coming down and results have been pretty decent, as you've already mentioned. And as a result, the performance has rebounded from fairly low levels, and the results have justified such a performance.
If you look at the months ahead, will that be sustained? Because from what I understand, that the earnings kicker has been a great deal because of the unwinding of the bad debts, and presumably that's now reaching a turning point. And the question is, where will the top line growth come from here onwards for the banking sector?
That's a good question. I mean, if we look at the banks on the one hand, the results have been pretty good, as you mentioned already. More recently, FirstRand guided to full year numbers of between 22 to 27%. The consensus expectations in the market were probably just above 20%. So they've beaten that by quite a margin. I mean, the other banks have also been fairly decent in terms of their numbers. I mean, Nedbank also has been in the region of 24%. Standard Bank more in the double digits, 14%. The one disappointment in the sector has been Absa, which you mentioned already. The results were down 6%, but that's really a specific issue due to bad debts. On the insurance side, we've seen very strong growth in embedded values as bond yields have rallied, and insurers have used a different risk discount rate to make their calculation, and that's translated in very good published numbers. And we've seen their new business numbers been fairly good. Today we've had Sanlam reporting results, and new business growth has been in the region of 38%. So even in that sector, which has long been seen as fairly lackluster, suddenly you've seen fairly decent numbers being posted, and the stocks have performed very strongly.
Yes, I think the interest of the market is also very much on their African strategies. They're being examined very carefully, and Nedbank's come up with it's got the option to take 20% of EcoBank. We've just had this arrangement between Barclays and Absa, which has still got to be consummated. And of course, Standbank's busy with its existing African footprint and expanding in Angola in particular as well.
And FirstRand, one just remembers recently having bought a bank in Ghana. So Patrice, that's also part of the banking story. And I go back to my initial question to you. Is it starting to remind you of the retailers, which is foreign investors buying into our African expansion story? Are we seeing that in the South African banks really expanding on the hinterland? You referred also to our insurers, and we're seeing that also with Sanlam, with Liberty Life, for instance.
I think it's interesting that you draw the parallel. I think there are some differences. If you look at the shareholders register, I don't think that the local financials are being owned to any extent by the foreigners. The foreigners have stayed away from financials. Maybe they've been burnt in their own home markets, as opposed to many of the retailers, which are now, in a lot of cases, largely owned by foreigners. I think that's one thing. Two, the valuations are vastly different. I mean, you have a number of retail stocks which are trading at multiples, PEs of 25 to 30 times. I mean, if you take Massmart, for instance. Whereas the financials, yes, they've had a good run, but they still trade on PEs of 12, 13, which are still very reasonable. And if you look at the price to books, I mean, apart from FirstRand, which is on a 2.3, 2.4 time price to books, the others are on like 1.8, you know, Nedbank 1.7. So they're not trading at extended valuations. They're probably close to fair value, but with strong results that is justified and underpinned. So we haven't had the type of re-rating in these stocks that we've seen with the retailers, and we haven't had the type of foreign money flow pushing these stocks to extremes like we've seen in the case of the retailers. So maybe it's still going to happen. Maybe you are right. Maybe they are going to be become the new retailers, but I think it's early days yet to call that.
Yes, I think that is really the question. Will it happen? Will there be a re-rating? Will there be some kind of discovery? But even if there is, I don't think it's going to be anything like as spectacular, dare I say exaggerated, as is the case with the retailers. But there's perhaps a little bit of uplift potential there.
I'd like to hear your response to that, Patrice, but then also long term, if you look at the long-term possibilities for banking, what I'm hearing from you now is in the short to medium term, definitely possibilities there. But long term, and much has been made of the new regulation globally, Basel III being one of them. And for the long-term insurers, there's an equivalent new set of regulations coming in. Still some uncertainty. It's being bedded down, but still some uncertainty on what it means in the interpretation of the local jurisdictions, what it means for profitability and so on. What's your interpretation of that?
I think that's a very good question. I think the key issue now in the financial sector, both as a result of Basel III with the banks and Solvency II on the insurers, is what are these banks, which are by and large very well capitalized, going to do with this excess capital? And does it mean that's going to be returned to shareholders in the form of a special dividend or buyback, or are they going to make acquisitions with it? And everyone's really sitting on the fence. I mean, today in the case of Sanlam, the excess capital is risen to almost 4 billion rands now, and they've said that if they don't use it for an acquisition by next year, they would return it to shareholders. In the case of, Steve already mentioned Absa. Absa is also one of the better capitalized banks in South Africa. If the Barclays Absa Africa merger does take place, maybe they will use up some of this acquisition. We've already seen Absa buying the Edcon book. So there are some acquisitions in the wing, but if they don't use up their excess capital, then I think the game in town is going to be higher dividends from these financials, which are not and haven't been in the past seen as huge dividend plays, but some of them already, the starting point are dividend yields of almost 4%. So if they up their dividend payouts, they could become quite interesting investment plays, given the fact that everyone's still searching for yield locally and around the world. And you might find that that attracts a new breed of investors who see them as yield plays.
And indeed what you've seen globally and locally is that dividend yield is almost regarded as kind of an alternative, a certainty, a source of income in this volatile and uncertain market. But I can't help wondering if it's almost unfortunate, because yes, it's attractive to have those dividends being paid out, but in the meantime these companies could have used this capital and invested it and possibly have generated better growth in the absence of having to hold on to the capital.
Yeah, it's always a very difficult question, Erica, because growth, yes, is a good thing if you can enhance the return that we as shareholders would have earned otherwise. But in a lot of cases, as you know, when you expand into markets which are not familiar to yourselves, it becomes very difficult to replicate that. I mean, Standard Bank is a good case study where they've struggled in emerging markets. Now they're trying to refocus on Africa, but it's not easy to duplicate the returns that you earn in markets where you're quite dominant, where you're the number one, number two, or number three. If you enter a market like in Nigeria, where you'll be number 10 or number 15, the returns are not going to be as good as in a market where you're dominant. So we would prefer management teams to be quite conservative and not try to just make an acquisition for the sake of it, of just growing the business, because what's important to us is not the size of the business, but the type of returns that our investment in these businesses earns for us and our investors. So so far, I think everyone's been very cautious. You mentioned even FirstRand's taken a very bite-sized approach to expanding in Africa with small acquisitions, like the latest one in Ghana. No one has gone for the really big bang approach, and I think that's quite wise. And similarly, Nedbank, as Steve mentioned already, are looking and striking a working relationship with EcoBank on the African continent first before deciding whether to up their stake. And I think that's quite wise. That's a low risk approach. It doesn't put a lot of their capital at risk up front, and it gives them time to understand the markets where they're going to go into.